This video will help you understand if you get to pay estate taxes when you die. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. In the typical coursework of doing financial planning for clients, it's not uncommon that as their resources and their net worth grow, their desire to give more to the next generation and or to organizations they care about also tend to go up. However, especially for first generation millionaires, the concept of paying estate taxes is a bit foreign, as it's oftentimes thought to only apply to the uber wealthy. Now, depending on your definition of uber wealthy, that might well be true. However, I think a lot of clients are surprised to know that when we run their long-term net worth projections, a lot of them actually approach those estate planning tax levels that are cause for concern if their goal is to minimize the impact of taxes on their plan. Failing to understand federal or state level estate taxes essentially just results in less money being able to pass on to the next generation or to causes you care about by way of paying thousands, if not millions of dollars to the federal or state governments by way of estate taxes. So in today's video, we'll help you identify if you will be subject to any form of estate tax, and then a couple of ideas on what to do about it. So let's jump in. Now, we're going to leave aside whether or not it's someone's civic duty to pay estate taxes or not. The fact of the matter is estate taxes are a matter of law, and as a result, we simply just need to plan around it, and generally avoiding paying taxes is not a recommended strategy. Rest assured, if you feel obligated to pay more in estate taxes than you need to by default, you can always send a check directly to the US Treasury by way of their website. In addition, I want to clarify that I am not a JD, I am not an estate planning attorney, so none of this is going to be seen as estate legal counsel or anything of the sort. I am an accredited estate planner according to the National Association of Estate Planners and Counsels, so that at least says that I know something about estate planning, but technically if it comes time to draft documents, sign them, anything like that, I'll refer you to an estate planning attorney, and I would not be the one drafting those documents. Okay, with that out of the way, for the most part, we can break up estate taxes into two tiers, federal and state level estate taxes. They work mechanically the same, but there's a couple of nuanced things to be aware of, and on the state level can depend on the various state that we're talking about. I'll link below so that you can identify whether or not your state has a state level estate tax. If there is no state level estate tax in your state, well then you don't have to worry about estate taxes. However, everybody will be subject to federal estate tax exemption levels, and so it's probably going to be in your best interest to at least know what those are. Now, there's other taxes that can apply at death, such as inheritance taxes or generation skipping taxes, but to keep it simple in today's video, we're only going to talk about at-death estate taxes on the federal and state level. So let's start with federal estate taxes because I think an understanding of that will help foster an understanding of state level estate taxes. So let's talk about federal estate taxes first. So as of 2023, the individual federal estate tax exemption is $12.9 million. That essentially just means that if you as an individual pass away with assets worth less than $12.9 million, for the most part, you don't have to worry about federal level estate taxes. However, those are today's numbers for 2023. It's projected that in 2026, when the 2017 Tax Cuts and Jobs Act sunsets, estate tax levels are going to decrease from federally being $12.9 million down to something closer to about $7 million. And that's because technically they're supposed to revert back to the 2017 levels, which are about $5.5 million, and then adjust for inflation to be around $7 million. Over the past 9 years, I've been told by the powers that be that inflation has been a little bit higher than normal. So is 7 million really an accurate projection? Not really, it's just back of the napkin. I imagine that the actual individual exemption will be a little bit higher, unless things change. So for the purposes of this video, we'll just use 7 million as a reasonable projection of what your individual exemption would be, assuming you're not planning on dying in the next couple of years. This also means with the sunset of the Tax Cuts and Jobs Act in 2026, that your income taxes are most likely going to go up as well. And lastly, there's new legislation being proposed from the Biden administration to decrease the individual exemptions down to closer to 3.5 million. Whether or not that's going to pass is anybody's guess. The estate tax exemptions are always changing, so please never take these numbers as gospel or an expectation that they'll last in perpetuity. Using 2026's federal estate tax exemption estimates of 7 million, that essentially just means if you die with less than 7 million in assets to your name, if it's under 7 million, you probably have nothing to worry about by way of federal estate taxes. I say probably you won't have to worry about federal estate taxes because technically there are things you could do throughout your lifetime that would decrease your lifetime exemption of 7 million, but we'll have to touch on that later. For example, if you die as a single individual with an estate worth $8 million, which is $1 million over the expected threshold of $7 million, we're projecting that a $1 million excess estate would cost somewhere in the ballpark of $345,000 in taxes. And if you die with an estate worth $2 million over that $7 million threshold, so $9 million, then you can expect to send the IRS a check for $745,000 in taxes. So as you can see, the numbers quickly add up the larger the estates we're talking about, so this becomes all the more important of a topic as your net worth grows. And it becomes all the more important to find ways of minimizing the impact of estate taxes on your estate, and we'll cover some of those strategies in future iterative videos. The primary method that a lot of folks, unbeknownst to them, use to decrease the impact of estate taxes is actually to get married. If you're married, you're afforded a few extra strategies that individuals who pass away aren't afforded as it pertains to federal estate taxes. The first one is called the unlimited marital deduction. And that essentially means that if I die, I'm allowed to transfer my share of our estate to my surviving spouse, and I won't owe any estate taxes as a result, and neither will she. It's basically, if you die, you can give everything to your spouse and vice versa, free and clear. In addition, married couples on the federal level are allowed to also combine their exemptions together. So again, going back to the example, if I die before my wife, I'm allowed to give her my full $12.9 million exemption using 2023's numbers, so that when she dies, she'd have an exemption of $25.8 million, which is her 12.9 plus the 12.9 I gave her because I didn't use it when I died. So not only does she get all of my assets, but she's also allowed to port over my unused exemption. And that porting over is notably called portability. So using 2026's numbers, if we both have $7 million in exemptions, and I die and I don't use any of my $7 million exemption, which is pretty common, I'll just transfer that $7 million over to her, as well as all my assets, and now she'll have a $14 million estate tax exemption when she eventually passes away. Now, if you're anything like me, it seemed like these numbers were completely out of reach. How many years does it take a family of 4 earning a negative income to reach $7 million in assets? Granted, yes, the current 2023 numbers are $12.9 million in exemptions per person, which combined is $25.8 million as a household that you're allowed to exempt from federal estate taxes. That doesn't apply to a ton of people, which is why not very many people actually end up paying any federal estate taxes as a percentage of the total population. However, using 2026's numbers of 7 million per person, a lot more people are going to be affected by those small rates. And of course, as the exemption numbers come down, if legislation changes in the future, then we are going to see far more people be subject to the federal estate tax levels. Getting to $7 million is actually not that out of the question when you think about it in reverse engineered math of if you and your spouse max out Roth IRAs every year from age 20 to 60, by age 60, you'll have $7 million in investable assets. This is assuming you get a 10% rate of return. Then it only takes about 8 more years for that $7 million to compound to over $14 million. And based on 2026's numbers, at $14 million plus, you will be subject to federal estate taxes. So from a high level, that's how federal estate taxes work. Now let's touch on state level estate taxes. As I mentioned before, the simplest solution here is just for your state not to have a state level estate tax. And if that's the case, you can probably skip this part. But it probably might still be in your best interest to know what other states are up to. It might influence where you decide to retire and eventually pass away. However, if you live in any of these states, then you do have a state level estate tax to worry about. And these exemptions are far less than the federal estate tax exemption levels. And many of these states have non-portable exemptions. What does that mean? It essentially just means use it or lose it on your individual exemption, as opposed to the federal level where when I die, I can give my spouse my exemption and she can have essentially like a double exemption for when she eventually passes away. On the state level, a lot of states have non-portable exemptions, meaning that when I die, I can't send that exemption over to my spouse and she can't double her exemption. We're both permitted individual exemptions, and if I don't use it when I die, I lose it for the family. Let's take Washington State, for example. Washington State has a $2.2 million state level estate tax exemption. In addition, the individual exemptions of $2.2 million are non-portable. So again, I can't give my $2.2 million exemption to my spouse when I die. It's use it or lose it. That means if I die as a non-married individual, or when my spouse eventually passes away after me, any assets above $2.2 million will flow directly to Washington State estate tax rates, which are between 10 to 20%. So theoretically, let's say we both do a great job saving and we have over $2.2 million in assets when I die, and let's say I predecease my wife. If she eventually passes away with an estate worth $3.2 million, which is $1 million over the 2.2 exemption that's all she'd have, a $1 million excess Washington state estate would cost around $100,000 in Washington state estate taxes. So to the extent one can plan around this, it probably would make some sense to do so, assuming again that your goal is not to pay a tax bill to Washington state. Okay, let's transition from here. So I mentioned earlier that there are some things you could do that would decrease your total federal estate tax exemption levels. One of the primary ways that you could accidentally reduce your $7 million exemption, again using kind of 2026's projected numbers, is by making excess gifts. So every year, people are permitted an annual gift exclusion amount. It changes throughout the years, but for 2023, that number is $17,000. That means I can give $17,000 to anybody I want to every single year for my entire life, and it won't affect my lifetime $7 million exemption amount. However, if I give somebody more than that $17,000 or the annual gift exclusion for whatever year this is, any money above and beyond that gift that I give to them is a dollar for dollar direct offset from my $7 million exemption. So for example, let's say I gift my son $117,000 to help him buy his first home. Well, $17,000 of that is totally free and clear, able to be given. However, $100,000 of that gift is above and beyond that annual exclusion amount, which means $100,000 gets chopped off the $7 million that I'm expecting to die and be able to exempt. So now my lifetime exemption goes from $7 million down to $6.9 million. Technically, you're supposed to record this gift on Form 709 if it's above the annual exclusion. If you gift below the annual exclusion, you don't have to file Form 709. To clarify though, this excess gifting does not reduce your state level estate tax exemption. It only decreases your federal estate tax exemption amount. Now, there are other things you could do that would add to the value of your federal estate tax exemption or add to the value of your state estate tax exemption. Technically, you can't increase the number, but you can definitely add to its value in how you use it for your estate planning. The most common way to maximize the value of your exemption are to use things called bypass trusts or credit shelter trusts. I'll touch on these in a future video, but essentially there are ways to ensure that if your exemption is use it or lose it, that you use it upon death of the first spouse. And there's other ways that you could reduce your estate tax liability by essentially just trying to shrink your estate before you pass away. Again, excess gifts could actually hurt your estate planning, so we don't want to do that. But gifting right up to that $17,000 number every single year to as many people as you want to every year is totally fine. In fact, married couples can actually combine their gifts. So my wife and I could give anybody we want to $34,000 every single year until the day that we die. You'd still want to track the combined gifting on Form 709, but that level of gifting wouldn't hurt our unified credit or the $7 million individual exemptions that we have. All right, so calls to action. Step one, I'd verify if your state has a state level estate tax. If so, it'd behoove you to be aware of what those exemption numbers are. Second course of action, whether you have a state tax or not, look at your net worth projection for where you anticipate your assets will end you up on in the next decade or so, and use that to fuel your estate planning. If you think you're going to hit certain state level estate tax exemption amounts, then you're going to want to plan around that. Same thing on the federal side, of course. If you think you're going to be encroaching on any of those levels, speak to your financial planner and speak with an estate planning attorney on some strategies to help you reduce the impact of estate taxes. So hopefully that was helpful. If you have further questions, drop them in the chat below or get in touch on the website and we'll get you squared away. Have an awesome rest of your week. Talk to you later. Bye.